ECB President Mario Draghi is cutting growth forecasts, announcing more cheap loans for banks. Our Steve Liesman joins us with all the latest today and the implications around the world. Morning, Steve.
Hey, good morning, Carl. The European Central Bank, a surprise series of dovish moves this morning, essentially reversing course from last year when it was maybe tightening up, now broadly downgrading its growth and inflation outlooks. Here are the actions taken by the ECB. It extended its low rate guidance from saying it will remain low through the summer, saying it's going to remain at current rates through the year end. Launched a new lending facility, the old TLTRO, and it will reinvest the proceeds from QE. Had been doing that, but now looks like it's extending it. Draghi pointed to both domestic and global factors for these policy changes.
The persistence of uncertainties related to geopolitical factors, the threat of protectionism, and vulnerabilities in emerging markets appears to be leaving marks on economic sentiment.
All of this leading the ECB to cut its forecast. Big changes. 2019, year over year, GDP 1.1. That's down 0.6 percentage points. Less so for 2020, down just 1/10. Inflation, though, that's the big marker because, remember, it's just a single target central bank, down to 1.2% this year from down 0.4%. And that led to a sharp weakening of the euro. You can see that in the next chart, but also European stocks. 112.29 is the number right now. It's been straight down all morning. Let's look at a broader index of the dollar. That has strengthened quite a bit. And that's probably one of the reasons behind U.S. stock weakness. And all of this, folks, will tie the Fed's hands. They're going to wonder how much of that European weakness is going to wash up on American shores, wonder whether they have accounted for all of that weakness in their forecast for the U.S. Second, they're going to be hard-pressed to raise rates this year now that the ECB is firmly going the other way once again, Sarah.
So my one question, Steve, is on the reaction in European stocks.
Just one? I mean, there's got to be 100 questions out of this action this morning.
I do have 100 questions.
I got a bunch of them. Time for one.
For one. So European stocks. I mean, stocks usually embrace stimulus. They like easing. They like a weaker currency, and they're getting all of that.
You're right. And so what we talk about in the central banking world is a policy response that's commensurate with the change in the forecast. Obviously, one of two things here. The market doesn't think, given the downgrade in the forecast, that the ECB policy response is either sufficient or going to work, Sarah. I mean, we get to a point where an ECB president comes up and says, we are confident in the return to 2% inflation month after month, and it doesn't return. And not only that, now they're downgrading. So maybe there's both an idea that it's not enough, and what they have is not going to work anyway.
And also there's this idea floating out there, Steve, that they're killing their banking system in the process. I mean, the banks are getting slammed the hardest. They've been choking off of all of this easy money for the last few years, and here we go again. Well,
that's also a factor, and you've had Draghi get up there month after month and talk about how effective the TLTROs are, and we don't see it. Now, some of it has to do with factors outside, but we were just talking, Sarah, offset here about the extent to which Draghi is not really owning the domestic weakness there. Why is Italy negative 2 quarters in a row? What is really going on inside Germany? How much of that is really from the outside, and how much of that is internal? Draghi seems to be weighing on the outside factors, less so on the inside factors. I wonder if it's time to be a little more reflective inside of the European Central Bank.